Bill, do you want to admit Brian?
Sure. Hi, Brian. Can you hear us?
I can hear you.
Great. Everyone can hear Brian? Great. Does it sit on your end, Woody?
Here.
I think everyone.
I don't even know where I was right
I
now.
was like, good, man. Sorry. It's like, oh,
Okay.
It's just noon, so you're right on time.
yeah, you're perfect.
Okay. Are you ready, Kelly? Okay. Today is Wednesday, August 6th, oil and gas meeting. Would you please take roll?
Mayor Sullivan.
Here.
Councilmember Lasky.
Here.
Jeff Rowe.
Here.
Doug Parks. Ed Bradford.
Here.
Okay.
Thank you. Asher Oil update, royalties.
We have amounts there in the packet to be getting them regularly, although I say that I think we didn't get a check in June, so sometimes they don't send them out if there's a glitch or things are shut down, so we just continue to monitor that and make sure we're getting paid up. So far we've been pretty good with them.
Okay, approval of minutes from April 17th, 2025.
So moved.
Second. Can you roll on that?
No, we just do a voice vote.
All in favor?
Aye.
Anybody opposed? Okay. Investment advisor update and commentary.
All right. Thank you, Mayor. Let me make sure we have the introductions here. I think everybody knows Brian from a number of meetings, Brian Walker, and then John joined at the last meeting, I believe. Might have been in the last two meetings, but Troy Snyder retired, and he was with us from the inception back in '09, and Troy was in charge of our fixed income investments, and now John we're very, very happy that John's taken on that role, and he's got a great resume in fixed income, and he's hit the ground running at Bartlett. So what we'll do is we'll take a few minutes and kind of talk about the economic market environment that we're operating in. If you go to tab 1, page 4, you'll see this market assessment. And this is a summary of some bullet points in terms of the pros and cons of what's happening. I think it's fair to say that the one word that best describes the economies and the markets is resilience. And for several years now, there's been forecasts of recessions, slowdowns, high inflation, all kinds of things. And other than a brief spike of inflation back in 2022, the markets, the inflation, employment has remained pretty strong. And last week we had another test of that. There appears to be maybe some weakness on the employment front, but this may very well be consistent with the pattern of the last few years, where we have these ups and downs and bumps and twists and turns in the data, but ultimately it proves that the economy still is pretty resilient, and that's good. And we have a few items listed here in terms of the positives, profits, inflation, employment, but then obviously still a lot of uncertainty around administration policies on tariffs. And of course, stocks reflect a lot of good news, which means they're kind of on the high end, not at a bargain level. So the next page just kind of shows some of that data in terms of unemployment and interest rates, inflation, corporate profits still growing. We can skip ahead a couple, let's say a few pages, and the page 8, which is federal deficit, and you can see that one concerning factor is a federal deficit that's at historic levels relative to peacetime or non-economic difficulties. So we have a good economy and basically the world at peace, and yet we're running very, very high deficits. And historically, that has ultimately proved to be a problem because it can be very inflationary when the government really starts to spend money to offset a weak economy or potential war conditions. And then
What's the OBBB? What is that?
I think that's the Office of Management and Budget, I think, is John, what is the, oh, that's the big, I'm sorry, the big beautiful bill.
Yep, you got it.
That's the projection with.
Yeah.
I got it.
Yeah.
Yeah.
And then, we referenced a moment ago, the stocks are a little bit kind of on the high side, on the rich side, meaning that they're not a good bargain. And you can see that on page 9, where the price earnings multiple, price earnings ratio is kind of at the high end of the band. Not worrisome, but just something to factor into a number of other considerations. And then the last page in that sector is page 10, a history of market declines. And I think probably most important item here is at the bottom of the page, and you can just, as the Manistee board is aware of, over a number of years, we have a 10% or more decline in the stock market about once a year, and we had that in April. And we have a 20% about every 3 years. And I should point out that back in April, after the tariff announcements, the stock market was down just a hair less than 20%. So technically, you could say that was almost, breached that 20% or more, but that's kind of the history of the declines. Any questions about economic conditions?
I just have a question. With the markets kind of hitting real high levels, maybe more broad-based than it was back when we had the tech crash way back in the day, but how do the technology sector, the NASDAQ, in terms of valuations compare to how it was back then? Are they as much overvalued or not anywhere near? Because there's a lot of froth with some of those companies, it seems like, with, everybody's going all in on AI, which actually has some true promise where maybe some of those other companies didn't, but just feels like there's a little bit of a...
Yeah, well, I think, 25 years ago was the birth of the internet, and there was a lot of speculative kind of euphoria over that, the excitement of that. But most of those companies that reached incredible valuations had no profits and very little in revenues. And a lot of those companies failed. There were, a few, Cisco, Oracle, Microsoft, that proved to have staying power, but I think you're right. There was a lot of froth at that point in time, and it was mostly with companies that didn't have, sales and earnings like these we call them hyperscalers, these monstrous tech companies, the Magnificent Seven or the NVIDIA. A lot of these companies we actually have in the portfolio. They're generating massive profits and sell multiples of earnings, where these in 1999 that was not the case.
So are there companies a few tiers down where they're having similar things as to what happened in the 90s, or not so much? People are a little more cautious of throwing money at those unknown
Yeah, I think there's probably a little bit of speculation, but nothing at all like 2000. I don't know, Brian, did you want to add to that?
Yeah, I'm sure there's isolated examples. Kind of the one large company that sticks out to me to your question would be Tesla, with a really high multiple. It was a little bit before my career, but certainly seen old charts comparing that time period versus now. And, there were a lot of companies in the early 2000s that were trading at multiples of 70, 80 times earnings or more. And a lot of those companies didn't even have a PE multiple because there were not earnings. And so kind of for the top 10 stocks in the market today, that multiple is about 28 times earnings. So it really is a very different situation. Another chart I've seen is that in the early 2000s, the top 10 stocks made up about 35% of the market, which isn't all that different from now, but the profitability of those top 10 companies they only produced about 8% of the S&P's earnings at the time, versus the top 10 companies now, which is really dominated by tech stocks, are producing more than 25% of the market's profit. So all that's to say that the multiples are high, yes, not nearly as stretched as they were then, and the quality of the companies now is quite different. So,
Thank you.
Any other questions? Okay, well, we starting about a year or two ago, we started presenting a special topic, and our topic today is kind of an evaluation of the risk of inflation or a stock market peak, and Brian's going to pick it up if you go to tab 2.
yeah, so the kind of have two checklists to go over with you. The first one is something we've put together called the U.S. recession checklist, and you can see there's kind of 8 items that you can kind of point to whenever there's a lead up to a recession or an economic slowdown. And certainly there's been lots of talk in March and April about a recession when there's more uncertainty around the tariff policy. But I think this really kind of came into focus again somewhat last week with the weak jobs report. But important to point out, of the 8 items that we typically see as the market moves into a recession, only 3 of the 8 are kind of checking the box or kind of flashing a warning signal. And so the first one, there's the single unit housing permits. We have seen a decline there, and that's kind of manifested over the last few quarters with mortgage rates have obviously been higher for a few years now, but it seems to finally have had some impact on housing starts. And that is a big part of the economy and something to keep an eye on. The third one there, the University of Michigan consumer expectations. The consumer sentiment, I'll actually point out, has been quite low, even going back to COVID. And it is very split along party lines, which you can see in the detail there. And really, we saw the reversal of that, where Democrats are feeling much more pessimistic after the election last year, and kind of before that was a reverse. So that has been flashing red for 3 or 4 years at this point. So still a concern, but I don't think it's a new concern. Probably the most salient one there is the new orders, and any reading below 50 shows that there's a retraction in manufacturing activity. And that is certainly the case. We've seen orders kind of slow down, and I think a lot of that is as a result of the uncertainty around tariff policies. So, and that can be an early read on recessions, and but I think it's also important to remember that we're much less reliant on manufacturing than we used to be as a broader economy. But that said, it is still important to keep an eye on. Everything else still looks fairly solid. We're not seeing a significant increase in initial jobless claims, despite that jobs report last week of new jobs. We're not seeing a big spike in jobless claims. And kind of the last 3 things there are all market related. The bond market remains pretty strong. We're not seeing any spread or increase in bond spreads, which is kind of an early indicator of risk in the financial system. And that would just mean corporate bond yields increase more than treasuries, and you typically see that as you go into a market slowdown. So not a perfect report card, but certainly maybe not as terrible as headlines would seem. The next one is the bull market checklist, and this is something that we also keep an eye on for some of these measures that you might see when you're kind of getting towards a market top, or and so we list examples of these, and we really saw all of these in 2000 in the tech crash, as we were just talking about, and also in 2007 leading up to the great financial crash in 08 and 09. So of the 9 that we have listed here. Really, the only item that we're seeing as kind of a rise in real interest rates. That's interest rates less inflation. But really not seeing big inflows into equity funds. M&A activity is still very muted. IPO activity is fairly muted. Number 6, earnings revisions have actually picked back up for kind of going into next year. So whereas it looks like earnings are kind of flattish for the rest of this year, analysts are expecting an uptick in earnings going into next year. So this generally points a fairly positive view, but open it up to any questions you may have.
So not a lot of bull market checks, not a lot of recession checks, so status quo, kind of just slight up. I mean, that's what it feels like, right? Resilient is what he said.
Yeah, I think it's probably a good time to transition to the accounts, and I'll let Woody take it from here. But yeah, I think just making sure we're in line with equity targets, which Woody will point out is prudent.
Any further, Jeff? Okay, let's go to tab 3, and on page 15 we have a snapshot of the portfolio. The Manistee Oil and Gas Fund is just shy of $15 million on June 30th, and we're pretty close to the targets with the target allocation with equities being 65 and we're at 66. The internal loan, I think, has finally been paid off. I know that was there for quite a number of years, or different ones, and that's been paid off. So, and then the next page, we have, I think some of you are familiar with this. We break the stocks in the portfolio down into 3 sectors. Those that are sensitive to the economy, those that are cyclical businesses, and those that are defensive, that are not, they don't move with the economy. They're insulated from the economy. Things like public utilities, healthcare stocks, soap companies, that kind of thing. The demand for those products is pretty stable through, strong and weak economic conditions. And you can see how we are weighted. We tend to be more of a defensive portfolio, which we do better in the difficult markets because we have a lot of these defensive stocks, and we tend to give up some performance in the strong up markets. Next page, John will pick. Yep. What was that? Okay, so who's that?
It's feedback.
I think we were just getting a little feedback. Keep going, we'll see what it is.
We'll move on to the fixed income, and John will pick up on page 17.
Oh, you're gonna have to. I was gonna say, I think it says feedback.
Yep.
Sorry.
Can you hear me now?
Yes.
Thanks.
Yes. Great. Perfect. Yeah, look, on slide 17 here, just the fixed income overall, I would make a comment here, as we think about the fixed income market and where the economy is heading, like Woody and Brian kind of alluded to, and where yields are. I mean, we're very positive on where absolute yield levels are in the fixed income market. So as we look at your portfolio, we're really operating in this 1 to 10 year maturity spectrum. And you can see on that top bar chart, the maturity distribution, those blue lines, those blue bars is where your portfolio is distributed from a maturity perspective. So we are buying bonds in those individual maturity buckets. And you can see that green line is the index, our intermediate government credit index. You can see we're a little bit heavily weighted there on that less than 1 year versus the index. As I talk about the current yield environment, we're very positive on it. And so as we have some maturities coming up in the next year or so, we feel very good about the reinvestment opportunities that we have in the overall fixed income market. if you look at the sector distribution bar chart, you'll notice that we're overweight in the corporate sector, underweight in the treasury sector relative to our index. We feel, we do the analysis on the individual corporate bonds that we're buying. We maintain a very high quality portfolio for you. But we just like to take that extra yield carry that's offered from a corporate bond over a treasury bond. So that's why we have that overweight there. I know it's been there for quite some time. We have added some additional treasury bonds over the last, call it, couple of months relative to the corporate sector. And that's just in anticipation that yields have the opportunity to move lower here over the next couple of months, over the next couple of quarters, as the Federal Reserve is starting to talk about introducing some rate cuts into the overall market. And then finally, on the quality distribution, those individual blue bars really make up an overall credit quality that's A+. And again, that's a pretty high quality portfolio, even with having that overall corporate overweight in your portfolio. So really what that leads to on that top right hand, that yield to maturity is 4.38% versus our index of 4.23%. And then the other line I'll call out is that average duration. So that's the interest rate sensitivity that we have in your portfolio. So we're taking a little bit less interest rate sensitivity versus what our index is taking, but we're doing so with a higher yield to maturity. And again, that kind of just comes with how we've kind of set up from a maturity distribution and how we've set up with a sector distribution at the current moment. Any questions on the overall fixed income portfolio or allocation?
I have a quick question, John. This is Jeff. Do we, with the roughly 15% of bonds year or less, are we going to stretch out that duration at all beyond 10 years, pick up a little more in the longer end of the curve, or will we stay 10 years or less?
Yeah, great question. And generally, so how we're viewing the fixed income market, one of the charts that Woody really showed earlier on with the deficit is, if you think about the deficit that the U.S. government is currently under, they have to issue treasury securities in the market in order to fund that deficit. And we feel as though, given where they may have to fund some additional deficit in the future, and the potential for inflation to reignite if the Fed does start to cut rates, we think that the long end of the curve could really move higher from here. I think that the risk is it moves higher from here and not necessarily lower. There's a lot of different variables in play. And so, yes, you could get some additional yield by extending further out the curve. But at this moment in time, we don't feel like it's the most prudent thing to do, given some of the risk factors that are in play. I'm not saying that the long end is definitely going to move higher, but I think there is a risk of that right now. And moving out further than 10 years probably wouldn't be in the best interest at this point in time. But certainly, if we do have a slowdown that or a potential slowdown, as Brian kind of alluded to here, not something that's our base case. That could be something we look to in the future.
Got it. No, understood. I think it's really interesting the way the yield curve sets up right now, especially because Treasury has said that, they're doing a lot of the financing on the shorter end of the curve right now, not the longer end of the curve. So I don't know if that's why we've got that, kind of U-shape or W-shape, whatever we call it, curve right now. So just wonder what your thoughts are.
There's definitely some Treasury curve manipulation going on. There's no doubt. As the administration continues to harp on, we need lower rates, we have to have lower rates. The reality is that they don't control, the Federal Reserve doesn't control the long end of the curve. They control the short end of the curve. The long end is really inflation expectations, how market participants are viewing the current economic landscape. And so you see a ton of the issuance right now is in T-bills. You're exactly right. And so that's why you see cash moving out to probably 6 to 12 months is high. And then it moves down from there. And then you start to see that 2 to 10 year part of the curve start to act more normal. If that changes, that's when you could, if that funding changes, if they don't try to fund all that through T-bills, that's when you could start to see some different areas of the yield curve move.
Thank you.
But great question. On slide 18, just looking at your cash flow and distributions, it's been a as I look at your spending rate at 3.5%. Just like to point out, at one point it was 4.5%, looking all the way back to your 2008 to 2013 timeframe. And I'd also just highlight here simply, as I look at your distributions at just shy of $7 million in that time frame, it's always fun to go back and look since 2008. Just the fact that the fund was at one point just under $7 million, and here we are, fast forward to current levels of just under $15 million, allowing you to have those distributions, and just the growth of the overall fund over time, I think is really important to point out.
Page 20, we see a summary of the performance, and you can look at the trailing periods here, going back up to 10 years. And, as I pointed out earlier, during very strong markets like we've had in the last 3 years, where the S&P has been compounding at about 20% a year, we're going to lag a little bit. And you can kind of see that in spite of having a 3-year return of 10%, we're a little bit behind the blend. As we were going through the portfolio this morning, if you go to the next tab, John and Brian and I were kind of reflecting on some of these holdings, of kind of reflecting on the Bartlett philosophy of trying to buy great companies at good prices and holding them for long periods of time, and kind of weathering the storms as they happen. You can see we have quite a big success stories here. Just going through, Alphabet is up about 15 times, Meta about 4 times, Lowe's almost 15 times, TJX, Berkshire Hathaway up about 9 times, MasterCard, that's up about 35 times from when we bought it back, I think it was in 11 or 12. Anyway, not to dwell on some of these names, but there's a lot of multiples of what we paid for the stock. Abbott 8 times, Amgen 5 times, Canadian Pacific, probably 15 or more times, John Deere, anyway, so I think that kind of speaks to the long-term holding, finding great companies, letting them, hopefully keeping them at a good valuation, trimming them when necessary, and potentially adding them when not, when they become better values. Brian, you want to maybe highlight a few recent transactions in the portfolio?
Yeah, I think the second quarter especially was pretty active. We had a lot of opportunity in April when the market sold off around almost 20% at one point in the early part of the month to add some really high quality companies to the portfolio. So in industrials, we had sold FedEx and bought another industrial, which we perceived was kind of an upgrade in quality in Eaton. Eaton's based in Cleveland and kind of is right at the forefront of some of the AI trade and improving the grid nationally and with all the demands on our grid from data centers and so on. So the early returns on that have been very good on that trade. We also, with as much as we've talked about technology, a lot of the really high quality companies had sold off significantly in April, and we already owned Microsoft and NVIDIA, but we added to those positions a little bit. You saw from our overall picture, we still have less in technology, but we felt it was a good opportunity to add to some of those really high quality names. So we added Microsoft at $370 a share. We added to NVIDIA at $109 a share. Those are at $525 and $178 respectively now. So those were some good additions. But we also added to JP Morgan. I think there's some tailwinds rather for financials and less regulations on banks with this administration. So we picked that up at $244 a share, and I think that's up around $280 now. So I think whenever we get significant sell-offs like we did in April, I think that's a great chance to buy really high quality companies that kind of sell off along with the rest of the market. And certainly seemed like there's indiscriminate selling in April, and there's a good opportunity to add some high quality names to the portfolio. We also did a little trimming in July just to get the equities back in line with the 65% target, and that's around the middle of July, and we've since drifted up to about 66%. So those were some of the recent transactions, at least on the equity side.
Questions?
So Brian, you mentioned the 65, 66%. Just for the benefit of the board, Woody and I have talked. We chat about stuff in between meetings and what have you. But one of the things that we did when we first started this portfolio, I think we were at a 60-40 equity or equity to fixed income, just because it was new. City had never done that before. I mean, this is going all the way back to 2008, and we wanted to make sure that we got the city and the board and the council comfortable with kind of the asset allocation. And then at some point we bumped that up to the current 65-35 or 65-35. But we've been through some downturns. We've been through a few periods of slow, and really the portfolio is working kind of as designed. One of the things that, given that this is intended to be a perpetual fund, some endowments have their asset allocation for equities up to 70-75%. It kind of depends on what it is. It's something that we might want to consider doing is maybe adjusting that asset allocation from 65 to 70, just 5%. You could get there in a stepwise fashion, but I just kind of wanted to float that out there, see what the temperature was of the board, if that's something they want to look at. We could certainly put some modeling together for the next meeting that kind of shows what that might look like in different scenarios, but it may not make a big difference in the spending allocation, in the short term, but in the long term with that compounding over time, it makes an incredible difference. And that it may be time to do that, because I think the portfolio is working as designed. The amount of the spending allocation that comes off, a lot of that is discretionary. A lot of that's decided at the time of the budget, and there is a little bit of flexibility there if there was some really horrific event that happened, which we would have a downturn even at the current asset allocation. It wouldn't make that big of an impact on the downside, but on the upside, it has the potential for 10, 15 years from now to make a really restrictive. Something to think about. I don't know kind of what the thoughts are, but we're happy to put together some analysis on that for the next meeting if that's of interest.
Would you be inclined with that additional, so you did 5% increase, would you be inclined to just broaden current offerings, or would you be inclined to say, let's take that 5% and make it really conservative, or let's take that 5% and just throw it to the wind, see what we can do with it?
We just ramp up with the existing
Just be
holdings.
more of the same.
Yeah.
As far as.
Yeah, and I don't think at this point in time, we would do that. If we were given the authority or we changed the policy, we wouldn't do that immediately. We'd probably let it drift up as the markets drift up. Instead of rebalancing, we would let it drift to that. Or if we had a significant correction in the market and the equities dropped down to 60 and the market was more attractive, we might then say, let's rebalance to the 70, taking advantage of the correction.
Because right now, or at least as of June 30th, the valuations are fairly high. It's not an ideal time to buy.
No.
And because of that, that's why you're seeing the equity allocation just slightly higher than the target, just because the markets have gone up. So it's a little bit of a timing
Yeah,
issue.
we're doing better in equities than we do in the bonds.
And we did an analysis like this, it's been a while, maybe 8-9 years years ago, just to kind of say, hey, here's what would happen in certain scenarios, kind of worst case, what that would mean for the spending rule. So we can dust that off, refresh it, do a little other things, and have a memo for the next meeting.
Makes sense.
I think the beauty of the fund, the way you have it structured, is the value of the portfolio, or the volatility of the value of the portfolio is not as relevant as you would expect, because the thing you're most concerned about is what you're taking out, and that's averaged over a 3-year period. So you could go through, I think Ed and I were playing with some numbers, the stock market could go down 40%, but given that the fixed income, as Jeff nods his head, would probably go up when the stock market drops. And so you may end up only a portfolio that's down 25 or 30% if the stocks drop 40. And then you did that in 1 year, what's that do to the spending? If you average it over 3 years, your spending only may go down 10%. So you may go from 450 to 410, or, I'm a little vague with the numbers here, but it's a modest decline, and given that a lot of your spending is somewhat discretionary, it's not like the end of the world for Manistee. If you went through a rough period, it's not going to have a terrible impact. Does that make sense, or does any feedback on that way of looking at it?
Right.
Yeah, and the other piece of that is, we've seen some extreme volatility, like the 20% drawback that Woody was talking about. It bounced right back up. It was just a buying opportunity, really. So sometimes those dips, if they're quick, they don't really register in anything, because it's only measured quarterly. So if you have, it just depends on the circumstances behind the drawdown of the values.
I think another way to think about it is, with the current 3.5% spend policy, you're taking out roughly $500,000 based on the current market value of the fund. Between fixed income and cash right now, we have just in excess of 5.1 million, so call it 5 million. You have 10 years worth of spending needs in very, very safe assets between fixed income and cash right now, and that's not including income the portfolio would produce. So I just think that's another way to think about it in terms of how much safety is built into the portfolio. You can have a pretty extended time period of bad equity returns without kind of impacting the spending from the fund. And so that's where, I think a modest increase to the equity exposure, knowing that the purpose of this fund is kind of serving the city in perpetuity long term. A modest increase in equities, I think, is not a bad idea, just given how much safety is built in, and the spend policy is what you're actually spending from the account is very reasonable. So just my 2 cents.
And the other piece of that is, we've lowered that spending rule down. It's probably at the floor. It's not going to go below 3.5. I mean, that's very conservative. So again, it just helps support this notion of, I guess you call it intergenerational equity, where we're not spending it all for the current generation, we're making sure it's there for future generations and preserving that purchasing power. And I think we've gotten to a pretty decent place with that. So, I mean, and you obviously can tell it's gone from 7 to 15, and we've still spent $8 million or $7 million. So, we couldn't have done this before we were able to invest it like we are. So this has been, it sounds like a broken record, but super beneficial. I mean, Doug remembers when we were investing in CDs. And
I remember sitting down at the dockside with the 2 banks
yeah,
and saying, okay, we got $500,000 to invest. Tark, what do you want to bid for CDs? And I'd sit there, or Dad, or whatever it was. Well, we'll bid this. Well, we'll do that. Let's split it, in half, and we'll each take it at such and such a rate. But we were also back in the late, or the early 80s when this was set up, and we were seeing 15, 16, 17% CD rates. So it was a pretty good return on not much of a balance. But until you were able to open it up, really.
I think it's interesting, and I don't know that everybody completely understands it. Ed, you kind of touched on it when you gave your report, but this is a gem of the community. I mean, it's a total asset.
it's a game changer.
It's a game changer, and not many communities are doing it. And I think whether it's through a newspaper article or when you showed the numbers of the increase from 7 million to 14 million, which has come, and it's not like our oil revenue has, I mean, it's
No, it's
it's
wrong.
not based because of it's
Right.
based because of the investments. And I think people kind of think, well, we got this oil well that everybody sees on the way to and this is generating all this money that the city's keeping. And it's like, no, it isn't. It's like, and I think that we need to talk about that. This is such a good thing for the city, and I think people need to realize that. And it's that you jumped on, and you did an excellent job on jumping on investing it. And then you've done a good job on investing it in the right things. I mean, it's been a combination. I wouldn't be afraid to toot your horns on this a bit and explain it, because the investment seems very solid to me, and the things that you've invested in, and the growth is amazing.
It seems like just yesterday we were celebrating 10 million down at the Bluefish.
Yeah.
Well, when I started this, it was just a tad over 14 million, and it's not like the oil royalties have gone up substantially to generate this. And I remember it was a tad over, just a tad, it was 14, whatever, barely over. And now, in that very short time, it has really gone up. So I think more of the community needs to understand this, and it's not for a bad reason that it's a restricted fund. It's an endowed fund, and I don't know that people always understand the value of endowed funds.
Try to reinforce that every time I give my annual presentation.
They skimmed over that. It almost needs to be a separate, because they're getting down the tube of the cities, treasury and all that. And no, this is the gem that we should be a separate.
One way to think about it is this is the people's money.
It is the people's, but it's the people's money for perpetuity. It's an endowed, it's not just for the people, it's for the people's children.
I remember sitting downstairs in a conference room with several commissioners who are city council people are no longer around. They just kept rubbing their hands every time they would look at the balance and let's spend more. We want to do this. And I think they were hoping to spread the wealth rather quickly. The board vote was not there to support that. But it's,
Well, I'd be very open to looking at that 70-30 split.
Yes. And then buy it when it was most, the opportune time. That it doesn't have to be 70-30 next week. It's like, well, you've done a good job of buying it when they're on sale, or whatever the term you all use, when there's the downturn.
Woody, can you talk about when you pull out that distribution? Are you pulling out proportionally from each allocation, or are you selling overvalued stock?
Yeah, well, we look at first the allocations, and if the equities are overweighted, we'll reduce the equities and use that cash to fund the balance. But normally, Ed gives us well in advance, and, we sort of know this is coming, really a year in
We normally
advance.
take it out towards the end of September just to have it on hand, and
Okay.
and we'll have some cash. I think we've got 70 grand sitting there now just from royalties and things like that, so.
And even the money
It's
market's
pretty orderly.
4.23%, so it's, yeah.
Yeah, so that hasn't really been an issue. We're always prepared for it, so we take care of it in advance.
Right.
Right now, we have about 800,000, so money markets.
Okay,
We're ready for it. We're ready.
great.
Good? Okay. Does anybody else have anything else? We have no public comment, so.
We like seeing you in person, Woody.
Yeah.
Thank you, it's great to be here.
for a month,
Take a motion to adjourn.
so moved.
Sorry, I couldn't make it up in person this year. Next year.
Just
Brian,
saying.
thanks, John.
Thank you.
Yeah.
Thanks, Brian.
Thanks so much.
All right. Good to see everyone. Good to see everyone.
For the weekend.
Yeah, here last weekend.
They're dealing with the Canadian Fire stuff. but
Doesn't bother me, does it bother you?
Don't
It's
have-
just been a thing, where it never was before, but,
My wife and I got a letter.
yeah. It doesn't bother my breathing that
Somebody
much, but
recently
it's kind of,
contacted
you can't
me
sit
on
a view
this
of the
date
lake. It's,
regarding your investment.
Yeah, right, I haven't had seen a sunset yet.
So I
which
looked and
I think that's
told her,
because
you're-
of smoke, right?
Yeah.
in the morning, you can see a very red sun, so that's kind of cool. I guess
Yeah,
maybe
well,
the
last night
sunrise
there was
is
a
more
really
of a-
kind of orangey fall.
That's what we saw Saturday. It was very orange.
Yeah.
Under the paper.
Yeah.
No.
Well, good to see you.
Hey, Bill, thank you. Yeah, yeah, thank you.
I'm so sorry.
It said,
Okay, I didn't even know I was supposed to start the meeting.
basically implied
It was right, it was perfect time. Oh.